Hello everybody, welcome to my channel. And today we will be looking at a solar tech company called Enphase. So the ticker is ENPH. And this token analysis will be based on the last quarter, let's say Q4 2019. And all the values that I will be presenting to you are based on a share price of $38. So let's dive in. The presentation will be split into 5 parts. The first 3 will be like to look at the specifically at each of the 3 statements, the income statement, balance sheet, and cash flow statement. From there, I will extract the main data, let's say value metrics, and then summarize them into what I call a DNA card, which basically gives you all the tools and information to decide whether you want to invest or not into the company. Just after this, I will do a quick metrics comparison, Enphase against Solaredge, which is another very interesting solar tech company. Quickly on the business, here there are some projections of how we will be using the power over the next, let's say, 3 decades. And as you can see, the renewable will play a very important part over the next 30 years. And if you zoom in into the renewables on the next graph, you can see that solar will be, let's say, almost 50% of the power, let's say, generation on the renewable sector. Quickly on Enphase, what I really like in Enphase, at least one of their products, that is really unique to this company, is that they develop microinverters. So basically, what is a microinverter is basically to let's say, quickly convert the power generated by the solar panel into something that is usable directly for consumers. And as you can see, one of their latest technology, which will be the EQ8, that will be delivered probably this year, will be able to provide, let's say, an off-grid system. So basically, you just need your power, your solar panel. You just put this microinverter, which converts directly into a usable energy power plug that you can use for your laptop, whatever, anything like this. So it's quite a revolution that's might happen, let's say, this year. Just on the technical side, as you can see, over the last 2 years, Enphase has been trading on an upward channel. And at the moment, at $38, we are in the, let's say, lower mid part of this channel. Okay, so it's not say the best entry point if you really need to look at on the technical phase, on the technical, let's say, aspect, but it's still not on this overvalued section. Now let's go into the income statement. So as you can see, I split 3 graphs, so margin, revenue, OPEX splits over the last 4 quarters. I usually do everything like this so that you can have a dynamic vision of how the company is progressing. And as you can see, for example, on the first graph, you can see an increasing gross margin. This is really something that I like, showing that the company is growing not only in terms of revenue, but also in terms of operating leverage. So it went from 33% to 37% because the revenue has been also very increasing, very, let's say, intensely, almost 100% in 2019 compared to 2018. Now you can see also that this effect of increasing gross margin and revenue has also led to an increased net margin, which is very profitable for the company. Here we go. Now let's look at the balance sheet. Same concept. Here I present you the last 4 quarters for each of the elements of the balance sheet. So as you can see, the first element will be Q1, and Q2, Q3, and then Q4. As you can see, first I look at the long-term debt. So what I don't like to see is a huge debt on this balance sheet. So okay, it's only, let's say, 240 million. But what you can see here is that it has been increasing over the last 4 quarters from 160 to 240. So plus 80 million more debt accumulated for 2019. What I look next is all liquidity, and especially the cash and equivalents that you can see has been increasing dramatically, let's say from 75 to 250 million. So it's basically generating a lot of cash. And we will see here on the cash flow, so on the cash flow statement, where to get this cash from. Also, what you can see that I don't really like is to get increase in receivables, let's say from 80 million to 145 million. And this is showing that basically the company cannot cash in all the revenue that it is declaring into the earning reports. But basically, I can see that the liquidity, total liquidity, what we call the current asset, is $500 million, which is massive. And basically, if you compare with the current liability, 200 million, this is where you can have the working capital. So basically, the working capital is almost 300 million. That could even cover the long-term debt. So actually, on an overall basis, the balance sheet is really good. They have enough cash, and the cash amount, cash money, let's say, is increasing over the last 4 quarters. I like it. Now let's move to the cash flow statement. I extracted basically from the last 10 Ks all the, let's say, the cash flow table and summarize it into this table. For the last 4 years, actually, you can have a taste of how let's say, they grow, what's the way to make their cash, and how do they use it. And as you can see, 2016 and 17 were mostly, so basically I split these elements into three, let's say, different elements: the financing part, the investing part, and in the operating part. Basically, in 2016 and 17, the company was not profitable. So that's why your operating cash flow here is negative. Over the last 2 years, it has been very positive, and then 2019 has been showing like really a leverage into their income. But as you can see, over the last 4 years, they've constantly raised money via the financing part. And here on the table, you can really see how they raise their money. And basically here, you can see that they increase the number of shares, okay, probably via warrant exercise, and also they add the debt to their balance sheet. So that was the $80 million of debt that I was talking to you about on the balance sheet. Just overall, also a very important point that you will need to look at on the cash flow statement is the capex. Capex is super important to know how much the company has to invest to get this revenue. And to me, it looks really like a light capex budget, which was like nothing more than just $15 million over 2019 compared to 161 million net income. And this is super interesting. You will see there on the DNA card. Just a last point on the shares outstanding, as I mentioned to you on the cash flow statement, they've been raising money via issuing some shares, and then over the last 4 years, basically, the number of shares has doubled. Not good, but this is normal for a growing company that needs to raise money. Okay, so now let's look at the DNA card. This is where I summarize all the values. And for me, the most important exercise here on this DNA card is to evaluate how much free cash flow they return, and then how much, let's say, what is the yield return of this company based on the free cash flow. This is what I see here, but basically, to make the calculation, we need first to identify what is the enterprise value. And the enterprise value basically is just the market cap, but adjusted so that you incorporate the working capital, the long-term debt, and also the long-term investment. As I mentioned, on the working capital, they had 300 million, and the long-term debt was 240 million. So basically, if I subtract the working capital and add the long-term debt to this market capitalization, I end up with an enterprise value very similar to the market cap. So no big difference here on this company. The earnings for 2019 were 88 million. So basically, I just removed the depreciation, which was $14 million, and I ended up with a free cash flow of 74 million. If I divided this by the enterprise value, this is how I get, let's say, this yield return. 1.5% is not really significant for a company, but it's still already profitable. If I make the same exercise based on the last quarter, which was actually more revenue, the yield return would go up to 3%. I also like to look at what would be the yield return if I removed all the R&D expenses. So basically, if just the company is just making this business, just selling the product that is doing, how much yield it would return. And it's only also like 4%. It's decent, but it's still not crazy to compare to some companies that I have analyzed in the past. Now let's look at the price ratios. Price ratios, as you can see, they are lighted in red. Why? Because compared to, let's say, this typical type of industry that generates, let's say, 40% gross margin, you should expect EV to sales of 4, something like 4 to 5. Okay, so it means that the company is slightly overvalued in terms of price ratios. Also on the price to cash, as you can see, is 20, so it means that they don't have much cash compared to their market cap. Usually you like to have something like less than 10. But this is just a part of the analysis. As you can see, what I like is that the long-term debt compared to their earning, yearly earning is less than 4. Warren Buffett was mentioning that let's say a healthy signal for a company is not to have too much debt compared to their yearly earnings. So it means that they would need basically 3 years of earnings to reimburse all their long-term debt, so which is still something decent. So it's a controlled amount of long-term debt. What I like also here to look at is how much efficient the company is, and you can basically get that from the operating revenue divided by the number of employees. They have only 600 employees, so each employee generates $383,000 of operating revenue every year. And the average usually sometimes is 150, 200, so this company actually is really, really efficient. Also, their cash per employee, what I like to look at is, especially during this pandemic, if you have let's say a sudden cut of revenue, how much the company has cash, and does it have enough to, let's say, pay all their employees at least for a year? And I think here, $400,000 per employee is really, really decent. Then the best one, sorry I didn't put the bad thumbs up here, thumbs down, but here is the operating leverage that I really like to look at. And basically this is what we saw here on this gross margin, net income increase, is that basically whenever the revenue grows, over the last 3 years it grew 94%, the OPEX doesn't grow so much. So what does it mean? It means that if the company is continuing their revenue growing, but keeping their OPEX constant, there will be a leverage. It means that the revenue might increase only 10%, but the net income might increase, let's say, 50%. And this is exactly what you want to have for a growing company. And this is really a key point for decision to invest or not into a company. So this one is a super nice operating leverage, and I'm really glad to see that at least for the last quarter they are still continuing this this type of revenue increase, but OPEX growth not so much. Now let's look at the comparison with Solaredge. Solaredge is already also another very, very nice company. And what I like to look at is compare the two DNA cards that are already made for Solaredge and compare them. I compared with all these, let's say, parameters that I consider very important to me. And basically, when one of the companies is winning on one of these criteria, I just give them a 1. But basically, you will see that they are just equal. They have 4 here and 4 there. But overall, I just want to give you a quick idea. First, on the free cash flow, the company basically is yielding a little bit more than Enphase. Also on the price ratios, Solaredge actually has a much lower EV to sales, for example, than Enphase. Almost twice less, even more than twice less than Enphase. But as you can see here on the operating revenue per employee, Enphase is actually twice more efficient than Solaredge. And it's super important to see, look, the enterprise value here is 5 billion here and also almost 5 billion here. But Enphase only has 600 employees, and Solaredge has 2 times, even 4 times more than Enphase to generate the same amount of, not of revenue, because they make some more revenue, but basically to get a similar, let's say, free cash flow return. Also, as you can see, I like to compare here the operating leverage. And The company Enphase has grown less than Solaredge over the last 3 years, but as you can see, the OpEx growth has been completely different from Enphase to Solaredge. When Solaredge increase their revenue, they also have to increase their OpEx, almost as much as the revenue increase. They need to increase their OpEx. So to me, it looks like it is a very high revenue increase. So it means the company is really, really good, but there's not this operating leverage that at some point will start benefiting Enphase. So overall, if I have to decide what should I invest for the long term, I would say Enphase has a little bit of advantage. If you want to invest for, let's say, for short term, definitely Solaredge will be more interesting due to their free cash flow return at the moment, which is better than Enphase. So I hope it's a little bit it's clear enough, but I think these two companies are very, very good, very good, let's say, investments. I just give an advantage also to Enphase because they develop very specific technology with their microinverter, and that's also the reason why I think that for the next years it might benefit Enphase compared to Solaredge, which is more like a classical way, let's say, to install let's say your solar system. So basically, on conclusion, Enphase has first a good balance sheet, as we saw, with a lot of liquidity. It benefits from a very good operating leverage, so revenue compared to OpEx growth. It's already profitable with a free cash flow return of 3%. Also, it has this competitive moat with what I described as a microinverter, and also their new generation will maybe benefit for off-grid installation. That might be like a huge plus. Also, because now they generate enough cash, there's a low risk of dilution, so it's good for the shareholders that will start investing there, that they know that they will not put water in the beer. And just on the, let's say, negative side, I would say that the price ratios for Enphase are a little bit high. It would have been better to invest, let's say, when the share price would have been, let's say, $30 or even a bit less. But this is what it is at the moment. And also the pandemic might slow down the solar transition because, let's say, the oil price might stay a little bit lower over the next, let's say, year or two, and we don't really know if it's going to be a headwind or tailwind. So that's it. I leave it here with you with the DNA card. I hope you enjoyed this presentation. Just let me know if you have any comments regarding this analysis. If you have any other, let's say, company that you have in mind that would be interesting to analyze, just let me know in the comments, and I will try to do some homework. All right, thank you very much, and then have a great day. See you on the next episode. Bye.